Welcome to Beyond Bitcoin, a podcast about all things digital assets, the global communities they are creating, the generations that are using and investing in them, and the challenges faced by the nations that are seeking to regulate them. The content of this program is not to be taken as investment advice. The opinions expressed in the program by the host and the guests are their personal opinions only. Remember, feel free to subscribe and share with like-minded friends. My name is Derek Graham. I'm the CEO of Portal Asset Management, and my co-host is Nitin Gower, Managing Director of State Street Digital Assets. Good morning, good afternoon, good evening, wherever you are in the world, and welcome along to another episode of Beyond Bitcoin. My name is Derek Graham, and of course, along with me today is my friend and colleague, Nitin Gower. Hello, Nitin.
Hey, Derek. Never a dull moment. What a week. And I chose this week to come to India, and everything seems to be blowing up. So let's spend some time talking about that with our guest today.
Yeah, that's terrific. Exactly. And you know, we always start this program with the statement, never a dull week. It sounds cliched, but frankly, there's never been a dull week.
That's true.
And
it is true.
It hasn't been. And so this last week is far from it. I'm not sure that this last week has put fiat currency and banks in a fabulous light. But here today with us is Kristen Ragusin, and she's going to help talk through that. So maybe a little bit of a background of that. So firstly, we're delighted to have you. You're very much an esteemed guest for us. And you know, we also are fascinated about how you're going to look at this space, because you've written a book called The End of Scarcity, The Dawn of New Abundant World. That's really interesting. And so I think that's going to captivate the audience and put some thought-provoking discussions into all of this. You've had 30 years experience. My gosh, you don't look that old, Kristen. You've had 30 years experience, and you've accomplished the Senior Vice President of Wealth Management of Raymond James, which is based in Boston, Massachusetts. You certainly had quite an education. So your education includes a master's degree from the prestigious Fletcher School of Law and Diplomacy at Tufts University. You also hold certificates in FinTech from Massachusetts Institute of Technology and in Money Mechanics from the University of Cumbria in London. So, you know, but beyond your professional accomplishments, I noticed that you've had a life of adventure. Your travels have included you to travel around the world. You've climbed Mount Kilimanjaro, and I've had some friends that have done that, and they say it's really hard work. And you've hiked through the Sahara Desert, and you've enjoyed studying at a spiritual school at the foot of the footlands of the southern India, and that I can relate to that, having done similar things to that. That's fantastic. And you've got a certificate of digital currency expert and you're an advocate for financial innovation. So you certainly bring this well-rounded view of both life, the fiat monetary system, and blockchain. So I'm going to just jump straight in, Kristen, and I'm going to ask you a question, because in the last week, we've seen a lot of activity, of course. So I'm going to say, like, in the aftermath of Silvergate and Signature Bank and, of course, Silicon Valley Bank, we've seen the Federal Depositors Insurance Corporation step in and underwrite the depositors' funds, you know, enabling all the depositors to get their funds back. I think that's a very wise move, especially considering Silicon Valley Bank is the bank, but it's the bank that the banks bank with in Silicon Valley, and really that's the future of the US, and so really worthwhile supporting. But at the same time, in the last 48 hours, Credit Suisse has turned around and had major client outflows since some incidents it had back in December last year. And the National Bank of Switzerland, the Swiss National Bank as it's called, has stepped in and given them a line of credit of 50 billion Swiss francs to strengthen its liquidity. So with major government institutions stepping in to fix what appears to be a system that's somewhat astray, how do you think the banking system is working at the moment? And how do you think the fiat system is working at the moment? And maybe you give us a bit of an introduction of actually how fiat works at all. Over to you.
Oh, it's so wonderful. You know, I think this is sort of what's brewing all the time, unfortunately, in the system. So it's just erupted above the surface.
Mm,
And this is part of how money, it truly is at the root of fiat. And the real root is that I don't think that we completely comprehend how fiat is created. We believe that the money multiplier, fractional reserve lending is well and thriving, and it really truly is not. So money is simply created through the creation process,
mm,
where when there is a borrower, the bank creates 100% of the money. So
mm,
in Europe for a long time, there was no reserve requirement. As of March of 2020, reserve requirements went to zero in the United States. And even I would argue for a long time, we've seen that with many different kinds of institutions. Most quote unquote small banks, you know, under 124 million, had zero requirement prior anyway. And so that doesn't give us a great deal of confidence, but that's not even the core of the problem. We would find the core of the problem when we sort of look at the boom that happened to Japan years ago,
mm,
and you look at how they ended up sort of with pernicious deflation. So, and this really kind of goes to the question of, do we centralize with a CBDC? Is that the solution, or do we decentralize, or do we do some combination? And so, when we look at Japan, where really, when they came in and sort of took over and revamped the entire economy by producing on the traditional world model that we're using today, by really producing the money for loans. And doing that through this centralized organization, asset bubbles are absolutely created. So what are we using for money? We say we're using fiat currency. Technically speaking, we're using bank credit. And there is a distinction, because when the Fed creates quantitative easing or quote unquote fiat from the Fed, it's reserves. Those reserves are not dollars that are used in the real economy. Those reserves go to fortify the banking system, right? So there's a big difference between dollars and reserves, high-powered
mm,
money and money that we use. So technically in the old model, we would say, okay, there was 10% on reserve with the banks, and that would allow them to produce, 90% more in terms of loans. But money is truly created when someone comes to the bank and says, I want a mortgage, I want this, I want that. And it's done through double book entry. And so the demand for loans or the creation of loans creates money, which creates demand. And so this fuels the asset bubble. Now, this would be fine, possibly, if the loans were created for true investment capitalism, if they were created for businesses, if they were created for investing in all kinds of things. But the vast majority of these loans are created for consumer debt. And so when we see the difference between housing prices from 1970 to today,
mm,
housing prices used to be maybe 3 times one person's salary. College educations were vastly affordable, if not almost free. And today we have almost indentured servants when children, when young adults are going to
yes.
school. And we have houses across the board that are almost 10 times salary, and certainly a couple's salary in cities. So why is this? And the root of it is really because we're using bank credit through consumer loans as our money. And what happens when those loans are repaid? Yes, the loan is retired, but the money in circulation is also destroyed. So there's no separate money base outside of us. There's no consistent stock of money. It's a constant illusion of borrower's debt traveling around that comes into existence when we sign a promissory note to repay it. And then how high the interest rate is how fast humans have to run on the hamster wheel to quickly catch it, repay, reborrow, catch it, repay, reborrow. And the lower interest rates are, the slower one has to run on that. So this is the real story behind banking crises. And so I would start there. And so, it doesn't even really matter how well capitalized these banks are, because we are wholly and totally dependent on the borrower's ability to continue to borrow for the system to run without a risk of total contagion.
Mm,
Yeah,
mm,
that's brilliant, Kristen. So again, thank you for being here. I've met you several times. And Derek, I'll tell you, nothing short of brilliant conversations with Kristen. And tell our audience, I'm always curious, Kristen, in journey of all of us getting into Bitcoin, the introduction, and eventually being enamored with what the technology itself can do, but also the conceptual element of why Bitcoin was born. This is 2008, the financial crisis, post-financial crisis. And believe it or not, I spent all day yesterday, which is why we are a day late for recording this podcast, in the same, the foothills of a southern state in India, traveling for a religious sort of thing. And I spend the entire time going and coming in trying to understand this complex financial system. This is both, again, the quasi, government entity, though many of the central banks are really private, for the most part. They do have some influence on the political side of the things. But before we go into complexity of that and expansion of that into some of the phenomenon that you described, help us understand what got you sucked into Bitcoin, and how do you see this, and tie that to things that you write about in your book, which, by the way, I think is nothing short of brilliant. I mean, you talk about the fact that the scarcity, which is sort of hallmark of blockchain, and how you address scarcity is quite interesting and intriguing. That we shouldn't need to have that scarcity as long as we have the economic fundamentals in place. So I'll pause here. Love to get your thoughts on that, Kristen.
Yeah, the truth is that we're really living with the illusion of scarcity, right? And so the natural abundance is actually always flowing. And there is really some confusion around money and scarcity. Bitcoin, when I found Bitcoin in 2009, I think I was even on just some chat boards and people were saying, we've started this thing, we need computers. Does anybody want to donate their computer to become a miner? And I was like, I do. But of course, unfortunately, I never knew how to follow through with that. But I probably would have lost it in the early Silk Road days anyway. I really, even as a little girl, I mean, I had to earn my allowance explaining to my father how the markets worked. My dad was very much self-taught. So when we would come home from school, he would say, what did my tax dollars buy today in terms of your education? So, and that was in the 70s. So I was getting $1 a week, to see if I understood interest rates. Truly, this is how amazing and interesting my father was. So I always believed that the markets and everything was working. There was plenty of money out there for everyone. We just had to, find something we fell in love with and contribute to others, and life would really flow in the right way. I still believe that. But when 2008 came, I saw that I was missing something, and that it was that I truly did not understand how the money we use comes into the real economy. And so at that point, I think I had opened an economics textbook, and the first tenet was money has to be scarce to have value. And I thought, what contradiction that was with my spiritual beliefs. And even the knowing of humanity, how we have passions and imagination and interests, and you can't really stop people from wanting to create things and contribute to one another. So the basis of Bitcoin, which really is wonderful in so many ways, and I'm truly a cheerleader for Bitcoin, I still had a very kind of religious, indoctrinated moment when I saw it in 2009 and said, no, it is not money. It is not money because its value is based in scarcity. So it could eventually become a phenomenal store of value. It certainly could be something that could help people either be a speculative type of asset to accumulate wealth, sort of in the traditional investment quasi-exploitative model that we would have, rather than the abundant flowing model. But the problem when you say money should not be scarce to have value, it sounds sort of heretical, and then the mind is posed sort of in this black and white dualistic concept. So people think that then I'm automatically saying that money should be unlimited. And of course, that's been the problem with a lot of, early crypto coins and all these things, is that there was no concept of value attached to the projects or to the coins that were being created. So money should not be scarce, nor should it be unlimited. It should be constantly equal to the productive value of the people flowing. So just like if we were given a test with 100 equations and we had to say, solve how many solve? If 70 solved, there would be 70 equal signs. There wouldn't be 50, there wouldn't be 100. Or if we had to go and measure a table, we wouldn't have to go and gather the inches first. we would continue to count. So money in its true purpose is meant to be the monetization of barter, the equal sign, the standard of measure, the receipt received for contributing to someone else, the store of value, but it has to maintain stable value like the inch or the pound or the scale. And so how can this be done? Well, it's been done many times in history, but it can't be done if money is bank credit coming out as mortgages. And it can't be done if there are only 21 million Bitcoin, right? Even if you can break them into Satoshis. And then when I argue, which can be, again, a little controversial, I don't see it getting outlawed. My personal belief is, yes, it's going to do well, even though it could be highly speculative in the interim. But, if powers that be wanted to get rid of it, it's very easy to do. Because once eventually, let's say that the value really expands and then it begins to trade as money, those with significantly more wealth can get on the other side of the trade and quietly take it out of circulation and put it on the shelf. And typically this is what's happened with all commodities that are quote unquote scarce. We can't really verify how scarce they are. But when you say that gold is the money, powers that be that want to politically or somehow economically create a dominance simply can ensure that that commodity is scarce and that it cannot be used for the overall broader credit creation that would be required for true investment.
Yeah, so if you were to look at, it's a great point, right? Because I've contemplated this whole notion of debasement of currency. This is the base. This is the M0 in contextual term. I think Kristen is what you're referring to. And the abolition of gold standard during Nixon era, which had some asset-backed money supply, right? And again, there's two sides of that debate to say, hey, we don't have enough gold to be able to support the credit creation that leads to the economic growth, and hence moving away from gold standard did well for the economy in general. And we see the results of that thinking now. And we've seen that in Italy, we've seen that in Turkey, in terms of the ability for the governments to borrow and the inability for the governments to be able to be loose with the monetary policies and eventually fiscal policies. And I've spent some time studying this to say, hey, if the base itself is sort of drying up, or the base itself is not sound enough for the sound money to be the case, can crypto solve some of that problem to be the truly sort of global currency of sorts? I'd love to get your thoughts on that front, because right now, none of the currencies in the world are tied to, they're essentially, again, we've seen that during COVID, 6 trillion was sort of released, and that essentially is the money supply coming, at the base. What are your thoughts around that? Only because there is this interesting dichotomy between the ability for the world to use money for its true sort of value account and medium of exchange versus value creation, which is I think what your book talks about in terms of producer credits. There is more value. I think post World War I, post World War II, we've seen new interesting monetary phenomena created with demurrage and encouraging people to be able to spend money as opposed to hoard it. Love to get your thoughts on that, Kristen.
What's ironic, especially having a lifetime in wealth management, the first and most important thing that we must start to unwind and really, really embody is that wealth and money are not the same thing. And that, in fact, money is dependent on wealth. And I chuckle because I know whenever I say this and I talk about it every day, people say, my gosh, well, there's that confused look. And then people say, well, if wealth is not money, what on earth is wealth? And wealth is truly everything we buy with money. It's everything we create. But first and foremost, it's our imagination. It's our desire to create things, contribute, our passions, our labor, all the plentiful resources of this planet. We can argue whether resources are not distributed well. There's certain areas where the planet is really not doing well. But if we just take an oak tree, how many acorns are produced from one oak tree? The basis of nature is abundance. And so all of this is wealth. We are born wealthy. Every single person is born wealthy. Every time there's a baby coming, that community is more wealthy because there's another being coming with imagination, passions, and gifts. And so we decided whenever it was better to live together, even if at times it's annoying, right? We still, our lives are enriched when we're together. And we have decided that community, because we all create things, and even I argue that we don't even really come to know ourselves until we contribute to one another. And so we decided money was a wonderful technology to assist us in better being able to exchange our creations and all of our goods and services. So when you think about it, this to me is sort of, now it's right side up. It starts with wealth. Wealth is inherent in us. It can't be separated from us. The desire to begin to manifest it is to create something. And truly, whatever you create of value, someone else actually wants. There really is sort of this energetic thing that, whatever we're really producing with heart and soul, it's wanted in the world. Now, that means that money's in the back seat. It's a technology that we as in society created to assist us. So at that point, if it's a mere technology like the phone or the computer or electricity or whatever, has it been designed correctly? And it's been redesigned over and over and over, just like you were saying when Nixon closed the gold window to foreign to foreign countries in the US in 1971. Even with the history of the US, the money system has almost been changed or altered in some way almost 7 times. I think it may even be 8 times. I have to go back and look. And so also money probably should be asset backed. So here is something that's a little bit confusing, because I'm saying money actually should not have intrinsic value. It's like the equal sign. It shouldn't be scarce. It should be flexible in value, but it should clearly represent some value. Now, if it's gold solely, the quantity is too thin, too small, and it also can be politically controlled by a small group of people or whoever decides to, right? There was tons of freedom, and people were much more conscious in the 1800s when money was bimetallic. It was silver and gold. And at that point, it was more ubiquitous. Silver was always known as the money of the people, and it allowed for the expansion of the West, really, and all the different kinds of projects that were going on, because the people had access to money that they could trust without the technology of blockchain. And, so we went through, really, I would even argue that the Revolutionary War was monetary, it was not religious. When the founding fathers came, or the colonists came to the United States, they were all in debt in England. And there was just not enough gold circulating. And so they created colonial script, which we're told is just paper out of nothing, which again, when you look at the historical record, that's really not true. They created this paper off of productive farms or land banks. And so the script that they issued represented the productive value of the people. And if the people wanted to be more productive, then they issued more script. And they were very careful about keeping that balance equal, except not all colonies were the same. Rhode Island was, not so fiscally responsible. They issued lots of script and they got inflation. So when the British saw this, and you can also find it in the records, where they called it the great mischief of the colonists that needed to be stopped, they issued the stamp tax, and soon the Tea Party came, but it wasn't from the tea on the tax. It was from outlawing this colonial script that was really producer-backed money. It really was money that represented the production of the people. And so this is actually what started the Revolutionary War, and the early Americans knew that monetary freedom was the basis of all freedom. So France and England sent tall ships to the eastern seaboard with printing presses, and they printed up all the paper money they could to destroy the balance, which again, without the technology, was easy to do. So in early America, they were on probably the correct form of money until 1812. When the War of 1812 came, the United States has basically been back on the British banking systems, I would even say today.
So, philosophically, I noticed in your book that, you come from a space of abundance versus a space of scarcity. And a lot of that is a philosophy of mind, to consider that all around you is abundant or all around you is scarce. In the world of digital assets, There's huge abundancy because there's so many offerings in solutions and utility tokens and security tokens, and of course currencies, cryptocurrencies occurring. One of the things that I've often spoken about is the fact that digital assets, securitization of assets and digitizing it and then fractionating it makes it become democratic. In other words, anybody, anywhere in the world can own a small slither of something anywhere in the world because it's been fractionated. So in essence, the aspect of fractionating and digitizing things creates abundance and should then go against the concept of scarcity to a degree. It's just you'll have an abundance of variation versus fiat currency, real estate, equities, and bonds, which is the traditional way of looking at investment assets. Do you see, this blockchain-driven environment with all of its digital offerings as being a really viable solution over a period of time to start changing this money game we see, this game that sort of says that cash is a medium of exchange, a unit of account, a store of value, divisibility, it's got portability, etc. And all of a sudden, people are in control of their own destiny. And do you think that's going to be problematic to the existing infrastructure that's in place?
I think it supports the existing infrastructure. Yes, I think it's so important. I think it's vital. I think it is the re-democratization of access to capital, of access to investment, of fostering creativity. It's all of what it's truly decentralized finance. And of course, there has to be an opportunity to verify. People have to be educated in terms of the risks they're taking and these kinds of things. And all of that can be moderated. It can be intermediated from a host, whether it's experts, it's even some types of insurance that could come, all these kinds of ways. It's all solvable, as is technically interest rate risk, as we even see with banks managing their capital. It's all technically solvable. But the main issue is really the difference between even money and investment. When you look again at nature, because I think nature is sort of the greatest metaphor of symbiosis and also embodying this seemingly contradiction which we embody, which is each one of us is completely separate, totally unique, irreplaceable, and yet we are all completely inseparable from one another. It doesn't matter what thing we touch in our homes or anything that we go through during the day. It required thousands of people to bring us
Build it,
that,
yeah.
right?
Of course.
We're
Yeah.
so connected. And so we really are like fingers on a hand. And so how is it that we can create our systems, our institutions, to embody the same type of representative paradigm? And because I think we've come from, oh, we're all separate. Oh, no, we're all one, that we get this kind of whiplashing back and forth. Maybe that's even the basis of the argument between communism and libertarianism, something like this. So when you look at nature, it always thrives through a biosphere of diversity. And when you look at what blockchain provides is in fact that prototype, that fertile ground that nature thrives with. And so if we were to have a multitude of issuers of anything, already we have by far more chance of fortifying the system, creating greater choice, having greater learning, greater development, greater innovation, and greater information for what regulation would really be appropriate. So this is also the concern about the central bank digital currencies, for even what type of benefits they would bring. They also create a pipeline that can easily lend itself toward totalitarianism. So how is it that there would be checkpoints on that? And you could even relate that to what happened in Japan. Japan made a hard change when really the US took over, or the US banking system took over, and everything went to central banks planning their economy versus the greater sense. And you had what was Tokyo worth more than California, something like that. And you had this incredible sort of steep pyramidal hierarchical class system suddenly. And so the problem when money is controlled and becomes scarce, you get oligarchies, you get the return of feudalism always. And so it looks like it's a battle of socialism versus capitalism. It isn't. It's really just saying there isn't access like the fractionalization, Derek, that you're pointing to, or certainly that, if we look at real estate prices and all these other kinds of things, the fractionalization of being able to be part, which is very different than a traditional REIT or real estate investment trust that one would buy in the stock market. I would think it's much more personal. It's much more viable. So it is this, it's what blockchain in its best form, it gives us the opportunity really with web, with 3.0 perspective that we get to monetize and own our own production, our own contributions. And, so for people, and when I talk about this sort of in diverse spaces and people who are afraid of blockchain or afraid of these kinds of things, I say, whatever technology is coming, it can be used for good or for bad, but it doesn't matter. It's always going to be used for both. So are we building systems, right? Where's our intention? And it doesn't matter, what it's being used for, as long as we're continuing to build and create other opportunities that are really solidifying that liberation and that flow for people.
So 2 questions for you, Kristen. You talked about CBDC and having delivered about, I think, 19 in my lifetime CBDC projects around the world. This is early days of experimentation. I think they've only adopted the technical element of it. This is tokenization, blockchain. But the fundamental tenets of introduction of money into the system still remains. So of course, in the West, the concerns around privacy, the concerns around supervision, concerns around the the ability for the government to be able to have surveillance, that's a concern. Of course, in some parts of the world, that's not the concern. The concern is digital penetration and ability for having economic inclusion. So it's quite diverse, the conversations, but it's still centralized governance, still issuance. So all we're doing is digitizing the form factor. So that's one data point, at least for me, to say, hey, while I get all the benefits of digital transactions, it's hard for people to hide money. It's hard for the black money or dark money to evolve, becomes harder because everything is traceable, which is not the case with cash. It's some of the advantages, the transmission of money, the transmission of protocols that allows us to be able to have programmability. All those are great things. But of course, as you rightly mentioned, any technology has pluses and minuses that we have to evaluate from that perspective. So that's one question. Love to get your thoughts on that. Second question I have for you, which I think is quite profound as you go into the Web 3.0 narrative, right? Web 3.0 being the sort of the catchphrase for all things creator-led. And you're going after producer credits, the ability for me to be able to issue tokens that are recognizing my credence in terms of ability to create something and putting value to it. And to your example, if I issue too much of that and I don't have a lot of creative power, then I'm sort of introducing inflation and becomes worthless over time. Given that we have 200,000 different tokens in the ecosystem, what is your sense of, knowing what you know and what you documented in sort of evolution of money itself, right? As a student of trying to understand money and its impact on society, how do you see these massive tokens, which many of them are fraudulent, many of them don't even meet the basic requirements of things of value, so to speak. And you're talking about the ability for me to be able to say, hey, Nitin is able to create token, Nitin does these things, so you can use those tokens to be able to leverage for his time or his skill sets. Or let's say I'm using Kristen's set of tokens for me to have access to your time, to your talents. How do you see that evolving? So again, long-winded questions, 2 parts to this. Love to get your thoughts on that.
Yeah, I'll start with the latter part. Truth be told, I'm really, even though it is production credit, I'm really saying that companies will do it. That's ultimately what I think we will see. I think it'll be unstoppable. In fact, I think for sure it's coming. I know of one that's already happening in California, but And even that would make the CBDC, regardless of which way it goes, completely tolerable and then also acceptable, because choice, as long as people have choice as to which money they use, and access to capital and access to their own money, then anything that gets created is perfectly fine, right? What I do think we're going to see, hypothetically speaking, because I have no evidence that this is occurring at this point, I think we're going to see Amazon issuing its own money backed by its credit. Apple, Toyota, Uber, Airbnb would be perfect examples. And they would also really be able to solve their, kind of smeared reputations by taking advantage of their contractors. I think the court case was just settled in California saying that Uber drivers really are contractors, they're not employees, which makes sense. But at the same point in time, to resolve that issue that, maybe the network is just profiting from the labor, if in fact Uber or Airbnb issued their own credit backed by a certain amount of rides or a certain amount of stays, and they only could issue X amount of credit limited by supply and demand. So how much supply do they have of the services they're promising? Limited by the legitimate market demand for those products and services, all of which would have to be verified through technology. And as the system got more sophisticated, it would be real time. It certainly would be a competitor to the bond market, or it would open another market, right? It might even make the bond market much stronger because we'd have total transparency of demand of all those corporate services and real supply. So if that happened, let's say that Uber and Airbnb were to issue their own credit backed by a particular amount, which they would set the terms of their services, it would be issued every production cycle. And then these dollars, right, would be in the wallet. Your wallet would be on reject immediately. And then you would choose which corporate production credits you're going to accept. Maybe you accept Monsanto, maybe you don't. Maybe you take Raytheon, maybe you don't. Maybe you take the United States government, maybe you don't. So it would work really in the true biosphere that way, and there would be real competition. So if you take this, then it's immediately decentralized finance, because these companies are doing a capital raise right away from their customers. The reputations are wholly important. It solves some of the issues that socialists would say are bad about capitalism, but true investment capitalism, which I argue today we don't have, would now come to the forefront, because the firms would be completely dependent solely on making their customers happy. And now, if those credits, so they could raise their capital without interest, they also would have certainly an ability to have a greater profitability, which then they could do revenue sharing with either drivers or homeowners and say, you have this amount of rentals, we pay for your house and your home insurance. You can update your bathroom, we'll pay for your car insurance, you can get car washes. There's a whole host of ways they could actually come back and support their producers. Yes. And then on top of it, it could inject money into the money supply that we know is legitimate, because it would be backed by a real amount of production that is possible. The supply exists versus the demand. And now it's not fake monetary inflation. So, and it's also circulating where the real people doing the work is. The problem when you create money through the banking system as bank credit, as mortgages, it typically stays at the top of the pyramid in terms of the finance, insurance, real estate sector, and the people doing a lot of labor in the work can't access the money. So even if they have great thriving businesses, because they have to repay their debt in Federal Reserve notes or proxy bank credit, it may be not flowing in time for them to pay their loans, and they can go bankrupt. So when you issue money straight from the producers themselves, it circulates where the real people are actually doing the business. So this I actually see it unstoppable. I have no evidence that Amazon or Apple or any of these, certainly Amazon has coin inside its own ecosystem for digital, but the other big part of this is you would have the parity principle, so that an example I could use, again, hypothetical, if Apple were to issue its own money, and let's say the iPhone 20 was coming, they would say, this is what we forecast as the demand for the product. And let's say they issued their Apple dollar representing a certain amount of credit for that particular product. Now, we might buy it just because I prefer to have Apple dollars. Maybe I think they protect my purchasing power better. And as long as someone accepts them, they're going to be accepted for money. And the wallets would do the fungible exchanges when we went to, we wouldn't have to say, oh, how much is this apple versus the coffee? No. We know the technology would do that exchange. But if Apple were to bring the product to market, and let's say they said there was just going to be $1 million worth of demand, but it turned out there was $100 million of demand for the product. Now my Apple dollar would be worth 100, but this is money. So it's not you want an NAV, just like a mutual fund or a money market, you want it to be at $1, right? So this is like a self-sustaining, this is the real stable coins. And I think this is really what eventually should replace stable coins. But nonetheless, so Apple now says, wow, we had 99 times more demand for our products. So, but who has their profit? The credit holders, right? And so now, but it's no problem. Apple just simply has to issue 99 million more Apple dollars. But how do they do that? They do it by spending. So now right away, companies are realizing their profit and their profits are flowing. So there's no hoarding. And of course, it's a free society, so they can choose any which way they want to spend their profit. Do they want to bonus themselves? Do they want to buy yachts and mansions? Perfectly fine. They do what they want. Do they want to clean rivers, plant trees, give salary increases to all their employees? Perfectly fine. But it's transparent. It's known to their credit, whoever's buying their credit. So, and then really where we start with this is communities. And this is what you saw. This is why I believe it's really Wildcat Banking 3.0. Farmers, communities, all types of people will have the opportunity to issue producer-backed credits backed by a certain amount of what they do. But again, it's usually not going to be an individual or a small business.
Yeah.
It could be a farmer or a set of farmers. And just think about it, if they had issued their producer credit worth a certain carton of eggs, it'd still only be worth those many eggs, but the purchasing power of those farmer credits would be worth a lot more than one Federal Reserve note today.
No, I completely agree. And I think,
it certainly shows you that there's no chance that a vision like this, an opportunity to fractionate both assets and personal effort, can occur utilizing a fiat currency distribution through banks. And the reason it can't occur is because you simply can't fractionate the assets. You can't put smart contracts around the offerings that these companies would have, or these producers or cooperatives would have. You can't create virtual frequent flyer programs off the acquisition. So if you buy an Apple phone and you buy an Apple laptop, then you wait a sec, you start to get headphones for free, and you start to get appliances and peripherals for free, etc., because your access is giving you those smart contract driven frequent flyer points that you're going to get with it, because you're starting to build a community around Apple. That doesn't happen with $1. It happens when you're creating community, and communities getting created, growing rapidly with Metcalfe's law, and all of a sudden power comes to the token and it grows too. And there can be dozens and dozens and thousands of tokens. Ultimately, as you say, a wallet can swap them instantaneously from one to another. None of that can happen with a fiat currency. And so that just the building of these communities off blockchains is, I think, an incredibly solid argument for the concept of abundance. But what we don't have in abundance is time. So I'm going to say thank you very much indeed for your time, and thank you so much for appearing on the show. For those that are listening, The End of Scarcity by Kristen Ragusin, really, it's an extraordinary book, because the concept of being plentiful versus scarcity is a great mindset itself. And a review of how the monetary system works is a fascinating thing to understand. Thank you so much for coming along. Thank you, Nitin, for inviting Kristen along. Thank you so much indeed.
No, I would echo that, Derek. And Kristen, thanks again. I think I read 2 books that made me think, and one was Bernard Leitner's Rethinking Money, and the other one was yours. It really helps you sort of get to the gravity of, and again, I think your book has embodiments of tokenomics, which people take it for granted, but it's such an important part of designing a system. And everything that we do in crypto space and the token space is built by the community, and hence focus on community in general. So very pertinent given the times we live in. And thank you for being here and giving us the time and your thoughts.
Oh, thank you. It was so much fun. I really appreciate it. Yeah. And I know that we can do this. So we are the first generation who has blockchain plus the ancient simple wisdom of money merging. So we are the generation who was meant to do this from thousands of years. It's exciting times.
Fabulous.
Thanks.
Thanks, everyone. Bye.
We hope you enjoyed our weekly conversation. If you have any questions, comments, or suggested topics, please contact Nitin Gower or myself on the emails displayed here or via our LinkedIn profiles. Feel free to subscribe and share with like-minded friends. Stay well, inquisitive, and engaged. See you next week.